The trades aren't set up now, but here's what my plan is. I want to do a 0 DTE butterfly, which we did the last time around the market holiday that we had for Juneteenth. But I want to do it on a very short-term basis. If we're looking at 0 DTE trades, there was actually a really solid, I used to, a lot of good information is out there about 0 DTE trades. And one of the more popular trades to do on a one-day basis is a butterfly trade. And the way the markets are reacting today, and we also saw this on Friday, is the S&P 500 index is up a little bit today, and we're seeing the VIX index actually go up with it. So the VIX is really confused, if you will. Right now, the S&P 500 index is up 0.75 of a point, and the VIX is up a point, or about 5%. 1728 is where it's trading. We sold a short put spread on Friday. I still like that trade. The index hasn't really gone anywhere because remember, we went to the July expiration. The July 16th, I think, is the Wednesday of the expiration. And the futures contract was trading right around 1925. And that futures contract is now trading right around 19. It's down just a smidge. We got the VIX index up a point. Well, we have the S&P 500 index up 0.75 of a point. So to me, what I'm saying is the market is befuddled. It doesn't know which way it wants to go. We're setting all-time highs. If anything, I think the path of least resistance today would be to the downside. But I'm just going to set up a fairly wide butterfly in the SPX today. I'm not going to try to skip strike it. I'm not going to do some weird ratio. We're just going to do a one-day at the money butterfly. And then if I have time, I'll go back and I'll look at the VIX. So here in this situation, 0 DT is the June 30th expiration. We're looking at the most at the money option contracts. And I'm kind of struggling if I want to go 20 points wide or 25 points wide. The difference here is that 25 points wide gets fairly expensive and it's a little bit risky for a one-day trade. But I think we'll go 20 points wide just because of the show. It just doesn't give us quite as wide of a range in order to do for the landing spot. It's not quite as sweet of a landing spot. So here's where I'm going to work. I'm going to lean right here. We're at 61.88. And like I said, I'm leaning a little bit more to the bear side of things. We're going to use call options. Just it's simpler to use call options. Since synthetically, you could use put options too, especially if you're doing at the money option contracts. The only time I ever use usually put options is if I really want to get bearish. But we're going to be kind of neutral on the marketplace today, hoping that the market kind of stays where it's at heading into the close, or at least finishes somewhere close to this. Okay, so here we go. We're going to go, I'm going to lean a little bit, very little bit to the bear side. You could either do the 61.85 or you could do the 61.70. So let's go in and look at the 61.85. We're going to buy this. So let's go down 20 points. We'll do 20 points. We'll do 20. I've been going back and forth between 20 or 25 all day today. I'm going to put this one on too. 85, 95, 205. Okay. And we're buying this 1 by 2 by 1. So it's $6. So we got a 15-point landing place, approximately. Let's send this to the what if calculator. So I'm not doing this big, very speculative trade. I mean, if I normally would do 5 contracts, maybe I'll think about 2 or 3 contracts, right? I'm looking at the total cost of the trade, very speculative trade, just thinking that we're heading into the shortened holiday week. This Friday, the markets are closed, Friday, July 3rd, and because of the 4th holiday. And I think people are, just relaxing a little bit. The VIX is acting weird. The SPX is all at an all-time high. And I think it's going to really, the last time around too, but I think it's going to struggle to try to make a new all-time high again, or at least blow that out of the water, right? So what we need is just for it to stay neutral within a range. So here is our standard butterfly that we don't do that often on the show. And we're going to buy one of the SPX June 30th expiration. So it's only going to last for the day. 61.65 strike call, sell two of the 61.85 strike calls, and sell one of the 62.05 strike calls. Now, if we can get 1 hour of time decay, considering that it's noon on the day of the options expiring, and the market stays fairly close to where it's at, we're going to be okay on this trade. I mean, you could think about getting out, making $1 or $1.50. So keep that in mind, that you're not looking to double on this trade, and don't get too fancy with it and think that it's going to just stay here all day long, if you will. But if I'm looking at this trade, I want every hour, every 15 minutes that goes by, time decay is going to be a big issue. And these at the money option contracts are trading for $11.65 on the call side of things. So that's got to go to zero by the end of the day. If the market stays right where it's at right now, right? 61.83. So the market has already moved against us. Got it. That always seems to happen to us, but we're at 610. Let's call it $6. Okay. I would put it in at $6. See if I can get filled at that. I think that's a viable point. These are going to be very liquid, very active trading vehicles today. We said 60, so it was 61.87 when we started. Now it's 61.82. So it just moved 5 points to the downside. All right. But very, very active trade. Watch it. Don't try to hit the home run. The home run means that it would be 20 points wide and you could sell it for $20, and paying $6 for it, you're looking at a 14-point gain. That's not the way that you're going to trade this. You're going to trade it. You're going to hope that over the next 2 hours we stay within the range, and then we're going to look at it and we might be up $1. Time decay is going to be ginormous. That $11 option contract has to go to zero by the end of the day, and that's where we're at. Now, I would adjust it. I would go down once again because the market's moving hard against us. Seems like it always happens when we start Options Guy TV. But 61.80, I would maybe think about doing the 6. Yeah, I'd move it maybe down to here. Okay, let's send it to the what if calculator, and let's see what happens if we move it down to 61.80. Dealing with live markets, going back, clear it out. 61.80. Okay, we're going to buy this one. Yeah, I don't mind that. Okay, 61.60. Here we go. Buy, sell two. See if we get it under $6. And then we're right at 61.20. So 575 to move it down. Yeah, we saved ourselves a quarter. Actually, we're looking at it. We could probably put this thing in. Yeah, I like this number that it picked. 565 is probably a possible fill. I would start there and go up by 5-cent increments. And I would send it almost as a fill and kill. And that's the way I would do this trade. I put it in, let it sit for a minute. And if it doesn't fill, move it. And then if it doesn't fill, move it. And if it gets away from you, then you just let the trade go. And that's the way that I would definitely trade this. Okay. So now on the VIX index, and I do see we have quite a few questions that are out there. Can we just send out the Doug one? Doug Sarbon? I have the VIX question. My 2 times is down while the VIX is higher. Do you think this is a spot or futures thing? Yes, 100%. That's what it is. And let's run out and I'll show you the futures, Doug, especially if you have the trade on. It shouldn't be down a lot though. The VVIX is hanging in there. It was right about 90 when we started. And right now the VIX of the VIX is trading around 90. That's a 30-day VIX, so it's not exactly perfect. Let me pull up. I'm going to, I showed you the way to figure out where the futures is at by looking at the prices of the option. And it's something called put-call parity. That's, to me, the easiest way to get there. But the Chicago Board Option Exchange also puts out futures quotes. And it's a little bit confusing the way that they have it all set up. But I'm going to show you the website. from the CBOE, and I'll move in. Let's zoom in a little bit. Okay, and there you go. And we're showing. Okay, so here's the July 16th expiration. So when we put this trade on, the last trade of the VIX, or the VIX futures contract. See, these are the weeklies, and they don't even have these out. They don't quote them. These are the normal monthlies, the VX, Q5, U5, V5. This is the August future. This is the September future. So right now, the VIX is down a little bit from when we did it on the futures contract side of things. I do think the market, what has really changed is that the probability of the Fed cutting has almost doubled since last week. For some reason, and I don't want to try to get into the minutia of it, but they do think that the Fed is leaning towards cutting more so than not cutting at this point in time. And I can look at those numbers if you'd like, but we're at 1888. So it was at 1825 when we put the trade on. The volatility of the options hasn't changed much, and that's just from looking at the VVIX, the VIX of the VIX. So right here, you shouldn't be down a lot. Oh, I have my 2 times VIX bull ETN. All right, so that trades differently, Doug. I personally, I just read your joke. That was funny. I personally only trade VIX index. I don't like to trade the ETNs, the spot ones. And I just saw that was the part of your question. It's hard to judge exactly what's going to happen with those, but they will track the futures. If you're looking at you want to look at the basis of the option contracts that are being used inside that ETN. It's always going to be a futures thing. The futures are what drive the expiration date that you're trading. If you're buying an ETN, you need to know what duration, what the terms and conditions of the ETN are, and what option contracts that they're looking to use. Because you cannot buy the VIX index, and that's what it makes the VIX such a different vehicle. Right? If you think of futures, you can actually, if you're trading futures on corn, you can actually buy corn. You can actually buy oil. You can't buy the VIX. And so the options that are trading on it, the VIX is just a number. It's just a fictitious number that's out there. And that's what makes it so tough to understand the trading of this index. All right. So let's look real quickly at our trade in the VIX. And I will also bring up okay, let's run back to it. So this is the July expiration. I never trade the weekly. I don't like to trade the weeklies. They're just not liquid enough. July 16th, implied volatility isn't really what it is because it's not based off of the futures. Here's the VIX of the VIX, which is 91.43, and that hasn't really moved much. I took a peek at it when we set up the trade on Friday, and it was trading fairly close to that. But just to show you what we're talking about, so the 1850 strike on the call side of things is more expensive, and on the put side of things is less expensive. And then if you go to the next one, the 1900, you see the put is more expensive and the call is less expensive. That means that the future is trading right in between here. And we know that already, even though that was a delayed quote. We knew it was right around 1888. I think that's what it said. So it's somewhere right within this range because this is where the call goes from more expensive at the money to where the put goes more expensive at the money. So it's trading right in there. And that's something called put call parity. Best way you're actually getting live quotes because these are live quotes in the VIX index. Okay. So we sent this, let's send this think I already did that. I sent that to there. So let's sell the 80, and we bought the 16. 64 cents. We put it on for 61. We're down 3 cents on the trade so far. But this is next week is when we'd probably want to look at it. It's the VIX going up today in an up market. I mean, that's a good thing for this trade. It's probably not a good thing for the market overall. We do got the Fed meeting within the VIX index, so that could be a rationale as to why the VIX is a little bit higher, leaning into that meeting. It's going to be a fairly important one. Will the Fed actually cut this time around? It's not a no-brainer this time. According to the futures market, there's a high probability of it changing, and let's look at that because I think it's worth it. And we got a few more minutes here. So what you want to look for, if you haven't done before, it's called the Fed Watch tool at the CME. And just stay here. Let's stay in the Tradier Pro, and I'll just pull it up, and I want to see exactly where it's at because it's really moved a lot, basically just over the weekend. Fed Watch tool. So right now, the July 30th probability of changing, we're at 425. It's saying now there's a 20% chance of it happening. Man, that hasn't moved as much as I thought that it had. So now if we go out to the September expiration and we look at it, there's a 75% chance in September. Oh, there's even higher. Because they're saying there's a chance of a 50% rate cut. So 75, 80. There's a 90% chance that they're going to cut at least 0.25% in September. But in July right now, the reading is 425. Yeah, is 20% chance that they're going to cut in July. A lot of what ifs out there. And so I think the VIX is kind of showing that accordingly. And let's pop out and I'll show you the website real quick. So we'll pop them back out. Yeah, there you go. And we'll share that website with you. It's website sharing day. Okay, so 30 days and 2 hours until the July 30th, 2025 Fed meeting is. You scroll down and it shows that the current rate is target rate is 425 by 450. That means that this means 425 by 450. There's an 80% chance of it remaining there. You go to this over here, which is a 1/4 point lower, 400 by 425, and they say there's a 19% chance of that rate cut happening. And that did go up. If you go back and you look at current, well, we're about, in one day we've actually gone down. Yeah, we're actually going down a little bit today. It was 24 a month ago. It's 20% a week ago, 18% now, and now it's 19%. Now, if you go out to the September contract, that one gets really interesting. So in the September contract, 1425 by 450 is here. They're saying there's only a 7% chance of them keeping rates there. 75% chance of them going 1/4 point, and they're saying 17% chance that will go 0.5 point to the down rate cut in September. So they're given a fairly high probability. Now that all changes if there's a change here. And I think a lot of eyes are on the Fed. The consumer sentiment and there, once again, mixed metaphors in the marketplace. The marketplace wants to go higher and it's trying to find reasons to go higher, and it's struggling with the potential news that is out there. Is the big bill going to pass in Congress? Do we still have some obviously a lot of geopolitical concerns that are going on, and they've kind of been put on the back burner for the short term. And we also have the effects of the tariffs, and are there going to be tariffs? Where are we going to land on the tariff scheme? So, yeah, that's where we're at with the Fed. So today, this is kind of does my argument a little bit. Thank you for that. That we are just going to go nowhere today, and that's I wouldn't mind doing this one-day butterfly today, and then think about doing it tomorrow. Same scenario. And either 20 or 25 points. It really depends on the risk that you want to put in. And then on Friday, the markets will be closed. So we'll be back on Wednesday, and we'll look at how our SPX trade did. Now, remember, don't try to be a pig in this situation. Pigs get slaughtered. And if you are up $1 or $1.50 on the trade, think about getting out. It's a short-term trade. That's a high percentage on the monies that you put in. Realize it's a risky trade. This is going to be a very volatile move. The market starts moving outside of your range. Feel free to cut your losses if you would like to. If it hits either the strikes on either side, if you want to, you can feel free to get out of the trade. This is one of the biggest things that's really nice about doing this, and I should have mentioned this earlier. Let's go to the what if calculator in the SPX as opposed to the SPY, because some people are probably wondering that question, is the fact that this is cash settled. So if you get into the SPX and you do a cash settled trade and you land somewhere in the middle at expiration, all that happens is that there's cash in your account where cash used to not be. That simple, that straightforward. You don't have to worry about exercise and assignment like you do in the SPY. And there's actually some tax benefits to trading short-term options in indexes. All right. Any other questions? Let's pop back out a little bit here. All right. Yeah. Go ahead and put Doug's comment up. I mean, there is a lot that's going on as far as the Fed is concerned, and I like this trade with the shortened holiday week. I like looking at 0 DTE butterflies. It's a trade that I don't bring up that often on the show because of the complexities of it. It's pretty much an all or nothing type trade. You put the trade on. If it goes outside of the range and you ignore it, you're going to get nothing. So it's a very active trading position, and it's something that you need to put on and you need to watch during the day. I don't mind if you put it on. We said $5.75 on our call butterfly scenario. You can actually put a sell order in to sell at $7 or $8 if you'd like. Somewhere, just have an order in to sell where you'd be happy with that profit, and then go out and manage the trade. Now, on the downside, I don't want you to put a stop order in. I want you to watch it. If it gets to your wings, that's when you're going to be nervous about the trade. And one of the things is that if it's at your wings, you own that option contract, and it's an at the money option contract. So you're not going to, that's the one time you're going to capture as much time premium as you possibly can. So it's not a bad area to get out of the trade if you see it hit the wings. But you could also just do it off of price and say, I'm going to pay $5.75 for this trade. So if it's $2.50 or $2.75, I'm going to get out of this trade. And then that would be your stop price. And that's when you would want to get out of the trade. And I would just send that one to the trading floor, but have your sell order in on the upside in case you get an upside surprise as far as the trade is concerned. And every minute that goes by is going to be big in the S&P 500 index as far as time decay is concerned. All right, that's it. I apologize for the technical difficulties to start with. New computer not working well, and I don't know why. But we'll get that figured out by Wednesday. So thanks for stopping in, and we'll see you this Wednesday for the next edition of Options Guide TV, and we'll see how our zero DTE butterfly works out. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.